Hey everyone, welcome back to Brown Girls Invest 2. Today we're going to talk about a simple yet powerful strategy that could help you immediately increase your rate of return on your retirement accounts. It's about getting out of those target date funds and switching to broad market index funds with low expense ratios. So grab yourself something to drink, sit back, and let's get into it. First things first, let me explain to you exactly what a target date retirement fund is. You've probably heard them called life cycle funds, target date funds. Fidelity will call them freedom funds, right? All of these are the same type of vehicle, right? These are mutual funds that automatically adjust asset allocation based on your expected retirement year. When I say asset allocation, I mean the percentage mix of stocks, bonds, and cash in that fund. The fact that they automatically adjust is pretty convenient, right? The idea is that as you get closer to retirement, you should be preserving your money, so the fund gradually shifts its investments from riskier assets like stocks and move them into more conservative ones like bonds. As you get older, your money-making potential starts to go down, so you need to preserve the money you have as you get closer to retirement. The goal is to minimize risk as you approach the time when you need to start withdrawing your money. But here's the thing, convenience often comes with a cost, right? You're going to have trade-offs, right? So you're going to have trade-offs for that convenience. Target date funds tend to have higher expense ratios, right, compared to other investment options. Expense ratios are fees. According to a 2020 study done by Morningstar, the average expense ratio for target date funds is 0.62%. That might not sound like a lot, but over time, those fees can really add up and eat into your profits and your returns. Now, let's talk about broad market index funds. These are funds that aim to track the performance of a particular market index, like the S&P 500. That's the Standard & Poor's 500, which is a basket of the top 500 companies, right? They provide exposure to a wide range of stocks, giving you instant diversification. And the best part, many index funds have incredibly low expense ratios. For example, Vanguard's 500 index fund, VTSAX, right? They have an expense ratio of 0.04%. That is a fraction of what you pay for a typical target date fund. So what kind of difference can switching to index funds make? Let's look at the numbers. Imagine you have $100,000 invested in a target date fund with an expense ratio of 0.62%. Over a 30-year period, assuming an annual rate of return of 7%, your investment will grow to about $574,000. That's not bad. But now let's switch to a broad market index fund with an expense ratio of 0.04%. With the same initial investment and annual return, your money would grow to $761,000 over a period of 30 years. That's a difference of $187,000. $187,000 over the course of your career can make a big difference in how you're able to live, right? And all you did was change the type of fund you were invested in. So I want you to see this for yourself. I'm going to show you with this rate of return calculator. I'm going to take a broad market fund and I'm going to match it up against some of the best target date funds as well as some of the worst, right? You're going to see the difference between what would happen for you. Say you were a 40-year-old and you were going to retire in the next 10 years. It's going to make a big difference. Okay, I have pulled up a report from U.S. News and World Reports. And what I did is I used the keywords of give me the best 2045 target date funds. The reason I use 2045, the year 2045, is that would give us a 20-year time frame before we were retired, if we were speaking of, judging this from here for 20 years, right? I'm also going to use a 10-year example later to show you an example of what it means for you when you are underperforming versus when you're beating the market. Now, first thing we're doing here is we're looking at expense ratio. So here is the report. They're not cherry picked. This is from an actual report. So here we have Natixis. I have actually never heard of that one, but what I'm really showing you is that it has a 0.54 expense ratio. There is a State Street Fund that has a 0.09 expense ratio. 0.59. TIAA CREF, which a lot of you may be familiar with because it's a very large fund. They have a 0.45 expense ratio. American Century, 0.83. It's really high. Prudential, 0.40. John Hancock, oh boy. That's a 1% expense ratio. That is extremely high. T. Rowe Price, 0.25. Okay, here we go. Another T. Rowe Price, 0.61. Voya, 0.21. Fidelity Sustainable, yeah, they have a 0.74 expense ratio. BlackRock, 0.09. Fidelity Freedom Fund has a 0.12. So again, I am showing you this so that you see that these things actually exist, yeah? And then you're gonna see the difference it makes in your portfolio if you're not paying attention to the expense ratio. Again, here's another Voya, 0.61. And 0.61, another 0.21, 0.74, BlackRock 0.09. All over the place, right? But on average, you remember I said that it is a 0.62 is the average expense ratio for these target date funds. Now, the next thing that I'm going to go to is a NerdWallet mutual fund expense ratio calculator, because now I want you to see what it means for your money and your portfolio. So I'm going to give a couple of different examples. Now, I use the year 2045 in those funds prior, giving us a 20-year time frame before we actually retire. I am going to only use $5,000 as the example. $5,000 that you put in per year for each of the 20 years, okay? So I've already populated the $5,000 here. Here's the 20-year time frame. And now, let me explain this. And so in each year, you're going to put in $5,000, and I am going to give it an average of 10% rate of return. We're going to speak about rate of return later. We're only talking about what it does for your portfolio with the expense ratio. So from that earlier U.S. News World Report list, I took down some of the expense ratios. I'm going to give you some of the worst, and I'm going to give you some of the best. So one of the funds, this wasn't actually on the list, but 0.08 is one of the Vanguard 2045 life cycle funds. It is, the ticker symbol, if you want to look this up, is VTIVX, and it is 0.08. And if I hit calculate, it will give us, after fees, which is this number here, $345,089.40, okay? That's in 20 years at a 10% rate of return at a 0.08% expense ratio. That's actually not bad. Now I'm going to move to, there's a Fidelity fund, which I don't know the full name, but it's FIOFX, and it has a 0.12% expense ratio. If I hit calculate, we're down to $343,000 after fees, okay? So now I'm going to move to, there was a Schwab that is ticker symbol SWMRX, and that expense ratio is 0.53. Calculate. You're down to $325,000. I'm going to move to a T. Rowe Price fund, which is ticker symbol RPTFX, and it has a 0.61% expense ratio. You're down to 322. I'm going to move to a, forget which one this was. Let's do this American Century, which is a 0.83. That ticker symbol is AADKX. Let's hit calculate. You're down to $313,000. TIAA CREF, ticker symbol TTFIX, is a 0.45% expense ratio, $329,000. It makes a difference, all right? Now, those were the target date funds. Now I'm going to move to a total market, right? These are the ones that I am encouraging you to move out of those target date funds out of those life cycle funds and into a total market fund. So I'm going to use three examples. The three examples I'm going to use are a Vanguard fund, which is VTSAX, and it has an expense ratio of 0.03. Now, remember the numbers we had been working with before. So this last one, you would have had 329,000. With an expense ratio of 0.03, you're at 347,000, right? That's a difference of $18,000. That kind of stuff matters. And remember, I'm only doing this with a $5,000 initial investment. If I move this up to say a $100,000 balance, right? And at the same 10% rate of return, with you only putting $5,000 in there per year at an expense ratio of 0.03, if I hit calculate, you're at $982,000. Now let's just compare that to one of the other, I'll do it to the average. They said the average was 0.62. Now we're going from $982,000 in a total market fund to a life cycle fund. Hit calculate, you're down to $892,000. Those type of numbers make a difference in how you are able to retire and if you are able to retire. So if you've put your money in a fund and you just let it ride, let's see what happens, right? You could possibly underperforming for years on top of years on top of years. And when it is time for you to retire, you find out you don't have enough money to do it, or because you've been underperforming for so many years and you've been charged the fees that you've been charged in that expense ratio, it makes a huge difference in whether you're able to retire now or if you've got to push that date out a little further, right? Or if you're able to retire at all. These are the things that you have to look at when you are getting more involved with your portfolio, getting more involved with your own financial literacy, okay? So let me get rid of this for a second because I want to show you something else. So now I gave you the average of 10%. Now, what I didn't tell you is that a lot of the life cycle, the target date funds, they're not doing 10%, right? And so let me change this to 10 years. And I want you to be able to look this up. I'm changing this to 10 years. And the reason is because some of the calculators that you can pull up, performance measurements, they'll go 1 year, 3 year, 5 year, 10 year. I want you to look up a 10 year on, we're going to go with this Voya, VTRMX. They have a 10-year rate of return of 7.46%. They have an expense ratio of 0.61%. And I'm going to hit calculate. So if you started with $100,000 and you put in $5,000 for the next 10 years, and you have an expense ratio on that fund of 0.61, and you're only averaging 7.46 over a course of 10 years, you're going to have $267,000 at the end of that 10 years. Let's compare that now to putting it in a total market fund. I used Vanguard earlier. I'm going to use Fidelity now. I'll use them both, actually. We're going to do all of the same things, except we need to change the expense ratio. So the Fidelity fund that I'm looking at now is a total market fund. It's FSKAX, and it has an expense ratio of 0.01. It has an average 10-year return of 11.97%. So remember, the average stock market return is 10%. So you're already beating the market by making 11.97%. You're doing better by reducing your expense ratio. If I hit calculate now, in this last example with Voya, you had $267,000. By changing that expense ratio, being in another fund, and by getting a better return from that fund, If I hit calculate, I'm at $407,000. That's $140,000 difference. That can make a difference in how you're able to retire. Once again, if I switch it to the to the Vanguard fund, Vanguard has a 0.03 expense ratio, and they're actually performing the same as the Fidelity, so they're at 11.97. Everything else is the same. If I change this, remember we had $407,000. In the Voya example, we were at $267,000. If I hit calculate, we're at 406. It makes a difference with the expense ratio. You have got to look at your portfolio, and if you are in any of these life cycle, target date funds, freedom funds, get out of them and get into a total market fund. It really will make a difference in the amount of money that you have for yourself and to be able to grow your wealth. Okay, I know some of you might be hesitant to make a big change to your retirement investments. After all, target date funds, they've been heavily marketed as a one-stop shop solution, right? But the reality is they're not the most efficient way to invest your hard-earned money, right? In fact, a 2019 study done by the Center for Retirement Research at Boston College found that only about half of target date fund investors actually end up achieving their retirement income goals. That should be an eye-opening statistic, and it should highlight the importance of taking a very active role in your own investments. By switching to a broad market index fund and managing your own asset allocation, you're putting yourself in the driver's seat. You're taking control of your financial future and giving yourself the best chance of possibly retiring with the goals that you had in mind, right? And here's the nice thing about index funds. They're not just for retirement accounts. You can use them in your taxable brokerage accounts too. In fact, many financial experts recommend using index funds as the foundation of any well-diversified investment portfolio. My Uncle Buffy is a huge proponent of index funds. That's Warren Buffett, by the way. In a 2013 letter to his Berkshire Hathaway shareholders, he wrote, "My advice to the trustee could not be any more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P index fund." Now, at that time, he recommended a Vanguard fund. He believed the trust's long-term results from that policy will be superior to anything attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers. Now, I like to joke about calling him Uncle Buffy, but like when Warren Buffett, one of the most successful investors in history, recommends index funds, it's worth paying attention to. That man did not make his money by accident. He did it by making good decisions and buying solid investments. You can do the same thing, so start today. Most retirement plans offer a variety of index funds to choose from, so take some time to do the research of the options that you actually have. I want you to look for funds with low expense ratios and a track record of solid performance. You look at the 3-year, 5-year, 10-year, and lifetime performance of that fund. You can do that on your brokerage account site, or you can go to something like Yahoo Finance. And remember, you don't have to go all in on index funds right away. You can always start by allocating a portion of your portfolio and gradually increasing it over time. You can move a small portion and then monitor how it's doing every few months to make sure that it's performing and gaining in value the way you would expect it to. If you're not sure which funds to choose, consider reaching out to your plan administrator or a financial advisor. You can also reach out to me. I can help walk you through the options that you have within your plan, and we'll see what's available for you there. And while I'm on the subject of seeking advice, let me just say this: investing in your financial education is one of the best things you can do for your future. The more you know about investing, the better equipped you'll be to make smart decisions with your money. So in addition to making the switch to index funds, make a commitment to learning more about personal finance and investing. Read books, listen to podcasts, and follow financial blogs. You can even look at channels like the one I have here. The more you learn, the more confident you'll be about taking control of your financial future. Now, this is all I got for today. We've covered a lot of ground. We've talked about the limitations of target date funds, the benefits of broad market index funds, and how making a simple switch can potentially add hundreds of thousands of dollars to your retirement accounts, right? The most important thing I want you to take away from this video is you have the power to make a real difference in your financial future. By taking a more active role in your investments, making smart and informed decisions, you can set yourself up for a comfortable and secure retirement. So don't wait any longer. Get at it as soon as you can, right? I hope that you got something out of this video. If you did, go ahead, share it with your friends, like and subscribe to the channel, and come back for the next videos, okay? Have a great one.